Chapter 5, Module 4, we're going to look at the adjusting and closing of accounts of a merchandising business. Now, the majority of these accounts are the same as the accounts that we adjusted and closed for a service business. The differences, of course, will deal with the inventory accounts. In particular, also cost of goods sold. Now, the key adjustment for merchandise inventory is where we have a physical count at the end of the year that will differ from the amounts that are recorded in the perpetual records. And that brings up a very important point, that even though you have a perpetual inventory system, auditing standards require that a physical count is taken each year. Now, it doesn't have to be an entire physical count at one point. You can count inventory at different locations at different points throughout the year. But the primary objective is to test the validity of the perpetual records. Now, there could be differences. Could be theft, damage, spoilage, or just inventory system errors. Perpetual records, again, must be verified by this count. Now, if there are differences, and we would expect typically that the differences would be shortages, and the adjustment would go through inventory shrinkage, but it will flow through the cost of goods sold account directly. So to illustrate, let's assume that the perpetual records show, and again, this is at the end of a particular period, the end of the month, this is going to be a perpetual record. So you do a search on the computer for a particular item in inventory, and this could be done, some of my clients used to count inventory every day, so that a particular location, you'd even go down to a particular shelf, and auditors would be called to go out and observe the physical count. And at the end of the year, we would determine whether or not the perpetual records were valid. Here, you look at one item. The item has a balance of $50,000 in the perpetual record, but then when you take the physical count, you only count value of inventory on hand of $48,000. So therefore, we have to make an adjusting entry for the inventory shrinkage. Inventory has to be reduced by $2,000, and the cost of goods sold has to be increased by $2,000. So the journal entry that we would make to record the adjustment due to shrinkage would be a debit to cost of goods sold and a credit to merchandise inventory. Now, the problem here is that by debiting the cost of goods sold and not identifying this as a separate account, unless you're doing something internally, does not permit the manager to understand the losses that are due to shrinkage, theft, and inventory of inventory, and again, or spoilage. Again, this is something critical to manage the inventory system. So by debiting the cost of goods sold directly, unless you have an internal record that keeps track of the amount of shrinkage or spoilage, you'd have a loss of information by debiting cost of goods sold directly. Now, for the closing side, now again, the shrinkage or the theft or shortages result from or result in an adjusting entry. From the closing entry side, we have the same process. So after the accounts have been adjusted, the temporary accounts, of course, are closed. Now, what is not temporary, what is permanent, is going to be inventory. So the inventory is permanent. So we have to close these temporary accounts. And the 4 steps in the closing process is exactly the same. And the unique accounts for our merchandiser are going to be the temporary accounts for inventory and sales. So from the sales side, you notice that you've got the sales revenue, you have your sales returns and allowances, sales discount, and cost of goods sold, which of course is directly related to the inventory, and the delivery expense. So these are the relatively new accounts, or accounts that were not seen in the service company. So again, you're going to close out the accounts listed or at least highlighted in blue. These are temporary accounts for merchandiser, sales revenue, sales returns and allowances, sales discounts, and the cost of goods sold. And this is, again, unique to the inventory, or bringing in the inventory. So is, in fact, the sales returns that are given. Allowance could relate to a service company. If you're dissatisfied with the service, they could credit your account. A sales discount could also relate to a service company. But for us, we're going to assume sales revenue, sales returns and allowances, sales discounts, and cost of goods sold are unique to a merchandising company. And in fact, cost of goods sold clearly is related to companies carrying inventory. So you notice that we're going to close revenues to income summary. We're going to close expenses and contra revenues, which have debit balances. Sales is a credit balance. And of course, the income summary is closed to retained earnings, and then we close the dividends to retained earnings as well. So again, the entries are the same. It doesn't change what we did before in terms of the debits and credits. Cost of goods sold and delivery expenses, I said, are additional expenses. But the key point is that the contra revenue accounts, which you have not seen before, the sales returns and allowances and sales discounts are closed in the same way as expenses. So that if you look at the closing entries that are listed, sales revenues debited, income summary is credited. Then you have a debit to income summary and a credit to all the expenses, which now include sales returns and allowances, sales discounts. These are contra revenues. So the contra revenues are included with the expenses. They're not expenses, but they're included with the expenses in this closing entry. And then, of course, you close cost of goods sold and the delivery expense. So the additional accounts are noted in blue. And at this point, the income summary account in this illustration, when we close the revenues, we debit the revenues, we credited income summary. When we close the expenses and the contra revenues, we debited income summary and credited those items. So these are expenses and contra revenues. And the balance is going to be the net income or net loss for the period, which will have to be closed to retained earnings. So in our typical fashion, we're going to debit income summary, credit retained earnings, and then, of course, dividends are closed to the retained earnings account by debiting retained earnings and crediting dividends. Now, these are no different than we've seen for any of our other closing entries. The only differences are the unique accounts that are needed in the case of a merchandising company. So, again, for a merchandising company, the unique accounts are sales returns and allowances, sales discounts, of course, we can say that sales revenue is also different because before it was service revenue. cost of goods sold. And we have the contra revenues, and of course, and these are for closing purposes, or temporary, and merchandise inventory. So the first four are temporary accounts that are closed, and the merchandise inventory is a permanent account. So for a merchandising company, we've been introducing some unique accounts. Now, we'll continue to focus on merchandising companies as we complete or go through the remaining modules of Chapter 5.